Hi, welcome to today's video. We're going to talk about how to stop paying income tax. Now, I know this is a great subject. Who wants to pay income tax? I don't know anybody that likes paying income tax. So let me begin this video by asking you a question. How would you like to know the simplest way to stop paying income tax? Now, this is not a trick question. This is actually a strategy I use with clients right across Canada. Other advisors who are licensed to talk about this also do this strategy. And it's a well-known strategy, except if you're not talking with an advisor who's licensed for this, then it's unlikely you've ever heard of it. And if you did, you just brushed it off because you thought, oh, this is a scam. It's not a scam. It's legitimate, and it's one of the most simplest things you can do to actually stop paying income tax and, more importantly, grow your wealth in a tax-free environment. There's that word again, tax-free environment. Let's begin. Let's get after it. If you're new to this channel, my name is David. I am an active advisor working with clients right across Canada, business owners, individuals, and families. And I make also videos on financial planning topics like retirement planning, estate planning, how to protect and grow your wealth. And if you're interested in learning about those things, head on over to my YouTube channel. There's a lot of videos I think you're going to enjoy. Okay, let's begin. Let me frame this whole session by not saying this is who it's for, but maybe you might see yourself in one of these two examples. You might be an incorporated business owner and you're investing your money inside of your corporation, so you have a corporate account. And I'm sure you're aware you have a passive income tax. If you're not aware of that, then you're about to be aware of that. You have a passive income tax problem. If you're a couple or an individual and you have a non-registered investment account, so we're not talking about RSPs or tax-free savings accounts, we're talking about a non-registered investment account, then you are exposed to CRA, to Canada Revenue. And the problem with that is you might have that account and you're paying income tax on money you may not need through your retirement. So it's kind of a bitter pill to swallow, having an asset providing an income to you that you don't want, and then you have to pay a high income tax on it. So let's dig into how that might work for both of these kind of individuals. Okay, let's start with the business owner. One slide, that's all it is. Passive income tax rule. Any money that you invest inside of your business that is not part of your operation, so this is your non-active assets that produces an income to your business, is called passive income. And the government is taxing you 50 to 54% of that in tax, a disincentive for you to actually invest your money inside of your corporation. And to make it even worse, for every dollar that you earn passively over $50,000, the government takes $5 of your small business deduction. That's that SBD that you see on the screen. They take $5 away from you of that $500,000 that you're eligible for. So if you earn more than $150,000 passively through your corporation, you will lose the entire $500,000 that you could have used. This couple might be two people that retired and they both have defined benefit pension plans. So they were teachers or government employees, that kind of thing. And they both have pensions. So their income, combined income, is kind of high, isn't it? It's nice. They're living a great retirement, but they're paying a pretty good income tax for it. And now if you add into that they might have a non-registered account. So maybe, for instance, they received an inheritance, right? Or they just done well and they've sold some kind of maybe some rental properties and they just got them cash sitting there that's growing in a non-registered, totally exposed to Revenue Canada, but because they have a high tax rate, they're being punished with tax. Maybe you've downsized and it's that time where your kids have grown up and moved out and now you don't need this big house, so you sell this big house, you downsize, and you put a big chunk of money, like $1 million or $2 million, into a non-registered account. Same as the other couple. You've got this money, you may or may not need it for your retirement, and you're paying income tax on money that you may or may not need. And what you're really also trying to do in all these cases, you're trying to avoid clawback your old age security. Now that begins at $79,000. So any money you earn above $79,000 starts to claw back your old age security. And when you pass $128,000 of income, that's when you lose your old age security altogether. So this is what this video is about. It's talking about that you have these asset classes that are providing an income stream to you, wanted or unwanted, but you have to pay tax on it. And I'm going to share with you how you can now take all that and put it somewhere where you're not going to pay any income tax, okay? Not just not income tax, but you're going to grow it in a tax-free environment as well. Let's begin. You're going to deposit your money in a life insurance, a participating life insurance policy. Now watch as I go through this, because this is pretty simple, but put in your comments. I want to hear below if you've ever heard of this before. If you've not heard of it, I want to hear about it. Say, David, never heard about this. Please, thanks for sharing this with me. If you want to know the full video on this, where I go into the tax tables, the math, the illustrations, look at this video up here and I go into detail. I'm not going to go into that kind of depth today because I want to just whiz right through there just to show you the strategy, okay? Here's the money you've got in a corporate account, or it's in a non-registered investment account, and you're going to deposit it to a participating life insurance policy. When you deposit the money to a participating life insurance policy, it grows tax-free. So whether that's $50,000, $100,000, $200,000, whatever you're doing, whatever you're putting in monthly or annually, it goes into that like a savings account, if you will, but it grows tax-free. But growing from where? Where's that tax-free growth? Well, the insurance company is going to pay you a dividend annually, so on your policy anniversary date, and that money gets added to the cash that you've also placed in the policy. So that cash goes into your policy tax-free. You don't declare that. It's not. You don't have to report that to Revenue Canada because it's inside of a life insurance policy. That's the tax laws in Canada, that any money that is deposited to a life insurance policy that remains in your life insurance policy exhibits no taxation, zero taxation that you have to report. Okay, so let's take a step forward with this. How much could you earn inside of a life insurance policy? Well, here's some actual numbers. A participating account, this is just one insurance company. It doesn't happen to be the highest return. There's other companies that higher returns. I thought I'd just be practical and show you one company. There's a 20-year return, participating account 6.85%. The S&P TSX over the same period from 2002 to 2021 did an 8.8% return on the investment. And you think about that. This is a pre-tax return. Inside of a life insurance policy, just say you don't pay any income tax on that dividend that you get. So that's 6.85%, no income tax. But the S&P TSX in a non-registered account, that 8% is pre-tax. So it's not that great. That's why I'm sharing this with you, because if you're in those categories, a business owner or a couple or an individual with a high tax rate, that's really not promising. It's not a great place to be. Okay, so what could you be doing? Let's run through how this works. Just an illustration, okay? And then this is a couple slides and then we're all done. There you are with your money. You've got it in your corporate account or it's in a non-registered account, and you're going to deposit that annually to your life insurance policy or monthly, however you like. And then you're going to say to the bank, I would like to take this money and I would like to use it as a loan that you're going to give me. So you're collateralizing, right? You're using it as collateral. And so the bank says, sure, no problem. You've got the cash. We're just going to lend you the cash. And they give you the money as a loan. Now, I'm going to pause for a minute. I want you to look at the screen and tell me what it is going on here. I'm purposefully leaving it here because I want you to see, tell me in the notes below, in your comments below, what is powerful? What are you seeing here? I'm going to tell you anyway, but I want you to just stop for a second because I don't want to go past it, because this is the most powerful point. There's cash in your life insurance policy. We haven't taken it out. That money is still there growing. Every year the dividend is being credited to the account. It's compounding on itself. It's still growing. The death benefit is still growing. The cash flow is still growing. And you're not paying any income tax on that. All the while the bank is giving you a loan, right? And if that money came from your corporation, you're now receiving that money personally and you're not paying any income tax on it. You've gotten around Revenue Canada. Now, if you want to know how, head on over to that video I was telling you about, because I tell you how. This isn't one of those videos where you say, call me and I'll explain it. Watch that video and I'm going to actually tell you how to do it. If you're an individual or a couple and you've deposited money, now you're just collateralizing it. You're actually now taking, in both cases, you're taking one source of money and turning it into two assets. Now, if you take that cash that you got from the bank and you invested it, like bought a rental property, now the loan becomes tax deductible. This is one of the most powerful things you could possibly do to not only protect and grow your money, but to grow it in a tax-free way, cut out Revenue Canada, and provide a non-taxable income. Now, why is it non-taxable? Well, loans are not income to you. When you take a line of credit from your house, do you pay income tax on that? No, right? Because it's a non-taxable event. They're actually just giving you money, but you pay interest on it, but you don't pay 50% tax on that, zero tax on that. It's one of the most powerful things you could do to grow your assets. Now, what happens when you pass away? The life insurance pays off the loans. The residual amount goes to your beneficiary or your charities. And now that could be hundreds of thousands of dollars. It could be millions of dollars. It really depends on how much money you're depositing to your insurance and how much you might be taking as a loan. So it's one of the most powerful things you could do to actually just change how your money, where your money is actually being invested. This is the key to all of this. Your money doesn't disappear. Your money is still there. It's just you're moving it from a fully taxable account to a non-taxable account. Well, that's it. I hope you enjoyed this video. I always end my videos by saying to people, we take care of your wealth management so you can take care of what's most important to you. There's my contact information. There's about 5 million ways to get in contact with me. Hope you enjoyed today's video, and I look forward to seeing you in the next one. Thanks very much. Take care.